When we talk about mutual funds, we've heard about those, and those came out in the 70s, and a lot of people are invested in mutual funds, and they just have a comfort level because they've been taught that if you want to diversify, the easiest way is to just put your money in a mutual fund and let some professional handle things for you. Well, let me just give you some facts and information about mutual funds so that you're a little bit more enlightened so you can make a better decision. Number one, a mutual fund is a group of stocks. It trades at what's called the net asset value, or NAV, net asset value. So at the end of the day, they take all of the stocks and say, where did those stocks close? That's called the net asset value. So during the day, if you said, I want to sell my mutual fund, it actually doesn't close until the end of the day when the net asset value is calculated. Now that's important because during the market day, there could be a lot of activity. Things could be happening. You may decide you want to sell, but you just can't do it quickly. It's something that you have to put the order in, and at the end of the day, whatever shook out, that's the price you're going to get. On the other side, if you want to buy the mutual fund, it's the same thing. They wait to the end of the day to find out what the value is, the net asset value of all the stocks in the mutual fund, and that's the price you pay. So they're bought and sold at the end of the day. You don't decide, you don't have control over which stocks are in there, the number of shares that are being bought and sold within that mutual fund, and the timing of that purchase or the sale. As a matter of fact, the managers have all the control in that. And that's part of what people are attracted to. I don't have to pay attention to my own money. On the other hand, that's the thing that you really don't like because you're not in control. And it's my money and I do want to be in control. I'm just going to say something from my experience. I'm a certified financial planner on 2 continents, and the reality is nobody's going to care more about your money than you do. So if you just let somebody else do it for you, well, what are their interests? What are they getting paid? Here's the reality. Those mutual funds themselves, they're pretty limited. It's kind of like being on a railroad track. They can only go one direction or the other. They can't go long and short. That would be a hedge fund. Mutual funds typically are just long. They buy stock, hold that stock. Now, mutual funds have to be invested in the market. They can't just say, let's go to cash and put the money on the sideline. Those mutual funds stay in the market and stay invested. Typically, anywhere between 95 and 98% of the money in the mutual fund has to be in the market. In addition to that, they have to stay invested, and regardless of the performance that they make, their managers are going to get paid. As a matter of fact, if you lose money, they're still going to make money. So you can make a 30% loss in your mutual fund and they're still going to earn money. As a matter of fact, many times they earn a bonus if they simply beat the market. If the whole market drops 10% for the year and your mutual fund only dropped 9%, you lost a boatload, they get a bonus. Now if that's attractive to you, stick with mutual funds. But it gets a little bit more than that. Sometimes people say they want to sell their mutual funds and they don't have the cash inside the mutual fund, which means the fund managers have to now liquidate. That's called a forced redemption. When they sell those stocks, it may not be the best time. Maybe the manager of the fund doesn't want to sell, but it's a forced liquidation. They have to come up with the cash. So they're selling at a bad time. On the other hand, if they sell and there is some kind of a gain, those taxes have to be paid. And the mutual fund doesn't pay it, you do. If you own the shares of the mutual fund, the tax burden is passed on to you. So there's a lot of things about mutual funds that people don't quite understand. But there's another key point that you may be interested in trading in. It's called ETFs, or exchange traded funds. It's like a mutual fund, but it trades like a stock, meaning during the day we can buy it and sell it. So those prices vary all day long and we can get in and get out. Now the ETFs that we typically or commonly are traded are things like the DIA, also known as the diamonds. That tracks the entire Dow Jones Industrial Average. Or the SPDRs, SPY. That's the symbol for the ETF that trades the entire S&P. Or OIH, which is for oil, or SLV, which is for silver, or GLD, which is for gold. Now typically these ETFs have lower volatility because it's the whole entire sector or market that's moving. So it's not a stock that could be affected with news going up and down quickly. Lower volatility, but it trades during the day. So an ETF could be a great way for you to trade, and Cool Trade does allow you to trade and track ETFs. It can be a really good way to go.